This Week in Economics by Numbers Man from WBRN Radio and on the Bostonred Network. The date is the 20th of July, 2018, the last program of 2018. We are looking at some important economic news here. The GDP, we'll get to it in a minute, grew at 4.1. The highest since 2014, 4 years ago. Many variables are linked to 2014, the stock market, etc. One must remember that was under the Obama administration, the presidency of Barack Obama. A different situation and a different set of facts. We were coming out of a depression, which was in 2008. It was 6 years out, but these financial downturns are very difficult to get out of. Now, this particular turn, as one would say, the U.S. economy is performing. There are a number of reasons for that. There was some preemptive buying by various actors before the tariffs were executed. Now, they did not come till June. Primarily. So people bought ahead at the lower price. That is not unusual. Also, we had the massive tax cut. Tax refund checks were coming out a little late this year, so that started in earnest in April after the April 15th deadline. So we'll say basically those refunds were moving out, and also new tax tables were coming out to May. So that was extra money in the part of pockets of consumers who fund 70% of this economy. But there's other evidence that consumers were buying, were dipping into their saving rates. We'll brush on that. And also at the same time, more credit card buying there loomed. The real estate market, of course, is in the doldrums. We'll talk about that from Bloomberg. So we'll get to the information now from the Bureau of Economic let's see, we get to it here. This is released on a Friday. It was embargoed. The Bureau of Economic Analysis. National Income and Product Accounts, Gross Domestic Product, second quarter. Now, this is just the advance estimate, the comprehensive update. $19.29 through the first quarter of 2018. Gross domestic product is an annual rate of 4.1%. You saw this glaring through for the second quarter, Q2. According to the advanced estimate, the first quarter real GDP increased 2.2%. That's to revise there. The department emphasized that the second quarter's advanced estimate released today is based upon a source data that is incomplete. That's one of the things to remember here. In fact, the biggest increase in the GDP in the second quarter reflects a positive contributions from personal consumption expenditure. That is PCE, exports, non-residential fixed investments, federal government spending, old-fashioned Keynesian pump priming, state and local government spending that were partially offset by negative contributions from private inventory investment, residential fixed investment, imports of which are subtracted in the calculation of GDP. Now, if we go down here, current dollar GDP increased 7.4% on $361.5 billion in Q2 to a level of $20.4 trillion in the first quarter. Current dollar GDP increased to 4.3%, or $209.2 billion. here. The price index for gross domestic purchases increased 2.3% in the second quarter, compared with an increase of 2.5% in Q1. The PCE price index increased 1.8% compared with 2.5% excluding goods, food, energy, etc. The PCE price index increased 2% compared with a 2.2% there. A current dollar personal income increased 183.7 billion in the second quarter, compared with 215.8 billion in Q1. Deceleration in wages, salaries, and government social benefits, personal interest income, non-farm proprietors income were partially offset by accelerations in personal dividend income, rental income. A deceleration in contributions for government social insurance is subtracted at a calculation of personal income. An upturn in farm proprietors income. Disposable personal income increased at 167.5 billion, or 4.8% in Q2, compared with an increase of 256.7 billion, or 7% in Q1. Real disposable personal income increased 2.6%, compared with 4.4%. It does tell some of the story of what's happening with personal income here. You don't see this a lot in the general reports. Personal savings, it was 1.051 billion, that's 1 trillion in the second quarter, compared with 1.094 billion in the first quarter. Personal saving rate as percentage of disposable income was 6.8% in Q2, compared with 7.2% in Q1. Source for the advanced estimate, won't get into that, but is posted on the Bureau's website. Oops. A new presentation of estimated federal and state and local investment in structures. This is from 1929 to 1996 is consistent with the estimates for 1997. Anyway, we won't get into so much of this. This is the long version as statistical change. We'll put this on when we look at it. We won't look at this table. We'll just pinch it on there. And we look at some of the quarters here, 2018 at 2.2, that was GDP at 4.1 in Q2. If we look at the table for 2017, we had, look at the whole year. We had 1.8% in Q1, this is last year, 3.6% in Q2, and 2.8% in Q3, and 2.3% in Q4. Now, in the election year, 2016, started off at 1.5 in Q1, and Q2, 2.3, and in Q3, 1.8, and Q 1.8 also. That was in 2016, 2015, at 1.3%, 3.3% in Q2. Q2 is usually the bang buster quarter. And in Q3 we had 1.6, and in Q4 0.4%. That was in 2015, and this is the year that they're looking at here, the banner year. 2014, negative 1.8%, and we had 5.1% in Q2 of that year, 4.5 in Q3, and 1.8 in Q4. 2013, let's see, we have Q3 at 3.2 and Q4 at 1.2. Just looking at a little bit of the historical significance to this particular situation. The charts here give us a little bit idea of what was going on. If we look at gross private investment, domestic investment, and we look at Q2, a negative 0.5. It was 9.6 in a Q1. Last year we had 8.8 in Q3, 5.7 in Q2 of 2017, and ended the year in the fourth quarter at 0.8. So we're now in a negative there, and while we're looking down the chart, a little bit of the historical situation here. Oops. Oh, we're trying to look down here. Federal spending, a negative 0.5 in, it looks like Q2. And if we look at that in 17, a little bit tricky here because I'm having to look without actually seeing my top tables, but I can kind of guess where it is. Anyway, that's the historic real changes here. Well, we'll take a look at some of these. We haven't taken a look at durable goods, for instance, goods, personal consumption expenditures. In Q, wait a minute here. At let's see, personal expenditures at 0.20 is what it was. Oh, oops, let's keep. That was 2013, 2017. So we really don't have those figures there. We won't execute with this. We'll just move on. Nonetheless, we will place that on our show notes page. And let's look a little at the roundup here. We'll go to Reuters, the economy, dollar trade keys, the U.S. Stock edge, they call it, the ability of your stock market to keep on the edge this year over equities and elsewhere in the world. That's Reuters' theme. Spurred by fiscal policy benefits, including the corporate tax cut, the U.S. economy's standout momentum relative to other regions has underpinned Wall Street's advance this year. And this is according to Christina Hooper, the chief global market strategist at Invesco. The outperformance of U.S. stocks reflect not just earnings, but expectation about that. And expectation is a very interesting variable in itself that goes to the psychology of the market. The psychology of the market, our expectation today, may or may not be the expectation 1 month from now, and that's what people have to understand. A clear read of the U.S. economy comes, of course, next week when the government unemployment figures come out on Friday, and quarterly results for more than 140 S&P 500 companies, including Apple. Facebook, of course, lost 19% of its value. International Monetary Fund, the U.S. is projected to post economic growth, according to them, at 2.9% this year, up from 2.3% in 2007. While in the EU, Japan, and China have slowed growth than last year. U.S. economy grew at 4.1%. We'll hear that number banted about. Return for the benchmark 500. Last year, they were 6% so far. This year, 2018, it was 10.5% in 2017. And this is after all of the tax cuts, etc. After rebounding from a 10% correction earlier this year, is close to all-time high. This is the market tracks for the best year relative to stocks in the rest of the world since 2014. You hear that number creep up. Change expectation from synchronized global growth to U.S. growth being better than the rest of the world, really due to fiscal tailwinds. That is from Smeber Thomas, regional portfolio manager for Northwest Trust Wealth Management. Dollar gains added U.S. equity fund returns for international funds, which require a costly translation into greenback investments. Rosy predictions there. The profits expected to range at 22.7%. That's for the 500 against 8.5% in Europe. That's according to Thomson Reuters. But the benefits from a cut in the corporate tax rate to 21% from 35% will wean next year. Now, this is very important when you start looking a year ahead, which investors look, because investors are in it for a long-term situation. So this is what, if you look at the Trump administration's policies, they are short-term, not long-term. Tax cuts, a big boost at the first of the year. Corporations gave workers standard 2%, some of them, in terms of raises, bonuses of $500 to $1,000. Walmart gave bonuses, a little raise. Now they've cut, of course, the workers' hours back. So in other words, this situation was very, very temporary, and you had consumers buying various things, so you see spending up in Q2. That is that story, but can it remain? No, is the answer there. And that's part of the problem with short-term situation, because the markets start to back up. Now, we look to Facebook, it plunged. People, investors are suing Facebook. The company wiped out $120 billion of stockholders' money. And it was down 19%. It plunged 19%. And Facebook and the other social media, of course, are looking there to see what happens. The G20 ag ministers expressed, this is from Reuters incidentally, concern about protectionist measures. They've talked about that. Non-tariff measures inconsistent with the World Trade Organization rules. That's according to the communique that was released on Friday. That's in spite of the meeting that took place at the White House with the head of the EU financial arm. Ministers in Buenos Aires, the G20 meeting of agriculture ministers, said they've affirmed their commitment to refrain from adopting unnecessary obstacles to international trade. On we go. Well, we'll look at the BBC here, basically the same thing on the plunge of Facebook. Very important there, to just under $35 an hour, despite Twitter reporting $35 a share. I'm sorry, an hour. User numbers fell to 335 million in the Q2, down 1 million there. And this is they include Twitter in here. It posted 100 million profit of 100 million, making Twitter the third consecutive quarter profit, with sales up 24% there, better than expected, 71 million. But let's place everybody under pressure. Our second quarter results will reflect work we're doing to ensure more people get value from Twitter. That's according to Dorsey. What they've done in the BBC is merge these two together. Dorsey said the number of daily users on Twitter was up 11% from a year earlier, saying this showed that the firm's measures were tuning the service into a daily utility. Anyway, the World Cup led to 115 billion user impressions there, contributed 30 million in revenue over the quarter. This is with Twitter. And also Twitter's future success said basing user engagement around sports tournaments. Twitter is showing, in fact, they'll have a baseball game, I believe it's today, or Sunday's game, I guess, the Giants game, elections, and smaller local events will be the key to Twitter's future success. So in other words, all things local. Big tech stock have been in the spotlight. Amazon reported results in the second quarter, but on Wednesday, Facebook, of course, warned. And one of the things out here, we'll do the Amazon thing while we're at the BBC here. Where's Amazon? Record profits there. Will this continue? Very interesting there. As consumers retreat, quarterly profits delivers quarterly profits a record 2.53 billion. That's 190 billion pounds for the first 3 months ending in June. About 12 times more than it made during the same period last year. Sales rose by 39% to 52.89 billion, slightly less than analysts had been projecting. Well, we won't worry much about that. Amazon shares jumped 3%. The firm's lucrative cloud business, Amazon Services, sales were up 50% over last year at 6.1 billion. Revenue from firms offering categories which include advertising more than doubled to 2.2 billion. Retail sales in North America were healthy as well, rising of 44% to almost 32.2 billion. Recruitment slowed in the quarter. Amazon is also starting to ramp up the benefits of providing infrastructure investment, allowing a less rapid spending growth. Music to ear. What is this? Anyway, on investors, the company told investors that it expects third quarter sales in the range of 54 to 57 billion. That would be growth of 23 to 31%. Now you can see that is a fall. Expect many of these in Q3 and Q4 to start to come back to where it is. We skip over here to Bloomberg, and we'll talk a little about prevent inverted yield curve. This is Chairman Powell. Greenspan had ruled the Fed. The investors became convinced that the central bank counted to prevent a stock market collapse, so-called Greenspan put. Chairman Powell is under pressure to adopt what would amount to a put on his own, except it would go to the bond market. While sounding simply to their words, Powell does not seem inclined to go along with the idea of running monetary policy to avoid flipping the curve. He acknowledges that this would not embrace their concerns. That is according to Lou Candell of Wrightson Consultancy on the Greenspan's put, which then Chairman Greenspan denied ever exists. The Fed cut interest rates if the market showed signs of cracking. Powell's put would operate in much the same way in the bond market. The yield curve inversed, the Fed would be expected to cut rates. Well, that is one of the rationale for raising rates. Then you can cut rates. If your rates are basically at the bottom, there's no room for cutting. Thus, no tool. Powell and his Fed colleagues meet on the 31st, that's this week, to August the 1st, to map monetary strategy in wake of criticism from the administration. While investors expect the Fed to hold policy steady, next week they see a better than even chance it will increase rates twice this year. They better get about it doing it. Investors have become more convinced this year that the Fed will keep raising rates. The yield curve has flattened, short-term yields rising more than long-term. This trend has been interrupted in recent days by the administration's disparagement of the Fed and speculation that the Bank of Japan will scale back its support of Japanese and global bond markets. Yield curve is flattened. Reminds me of why, anyway. Given the timid U.S. inflation expectations are necessary to push monetary policy normalization to such an extent that the yield curve is inverted. That is from James Bullard. He is the chair of the St. Louis Fed, said in Glasgow, Kentucky on the 20th of July. Powell sought to shift focus away from the curve per se in his congressional testimony. We reported that. You look at, listen to last week's show. We have his testimony there. Not all the questions. That's an edited version. The raising of the Fed's rate to target 1.75 to 2% in June. The Fed described this policy as accommodative and continuing to support the economy. So, former Fed official and Cornerstone macro partner Robert Perley said the market seems to place a neutral rate somewhere higher at 3.25. On its face, that would imply that the Fed could invert the yield curve. The yield on 10-year treasuries is now at 2.95% without needing to worry about overly restricting the economy. A yield curve that is flat or inverted doesn't mean that the policy is tight, so it must mean we are going near neutral. That is Professor William English at Yale, who stepped down as special advisor to the Fed last year. Asset purchases, this is called quantitative easing, had been much maligned by conservatives. Massive bond purchases by the Fed and other central banks have held down long-term yields. These purchases have turned the premium, the amount of extra compensation investors demand to hold long-term debt, negative, according to calculations by some Fed economists. While a flip in the yield curve has been a dependable precursor of past recession, it's completely not clear why this is the case. And we have many people using the R word out here. you get a slowdown of credit growth with a big with a time lag. That is from Global Advisor Pacific Management, Joanne Fales, that in turn contribute to economic slowdowns or recessions. Well, credit has been very, very accommodative a month after taking over as the Fed chair in 2006. Ben Bernanke played down the gap's importance. Today's debate over the significance of the yield curve recalls a similar discussion ahead of the last recession. I would not interrupt the currently very flat curve as indicating a significant downturn, he said in a speech. 20 months later, a depression came. But that was 21 months later, almost 2 years. That's a different situation. Let's move on here. We'll briefly talk about Caterpillar. Caterpillar income reached an all-time high of, $6.24 billion on the expanding economy, selling of diggers, bulldozers, dump trucks, but the shares had their worst first half since the 2009 depression. They've been slow to rebound. Caterpillar gets more than half of its sales outside of the U.S. And, of course, an escalating trade war is menacing to global economic prospects. Retaliatory tariffs from China, Mexico, Canada, and Europe could cause headaches at Caterpillar. That's the biggest risk. That is from Larry DeMara, an analyst at William Blair and Company. Trade wars absolutely could have an impact and spill over into the global economy. We could have an impact on a strong cyclical Caterpillar is seen at the end of the market generally. Revenues in Deerfield, Illinois-based Caterpillar is forecast to rise $14 billion in Q2 from $11.3 billion the same time a year ago. On the average, 13 analysis estimates compiled by Bloomberg, net income is expected to rise to $2.59 a share from $1.35, the company reports. So we'll see where Caterpillar ends up here. U.S. companies target wedges and efficiency hacks as hiring toughens. Labor market's red hot, but companies' earnings calls show little evidence of businesses getting burned. July job data released for August the 3rd expected to show unemployment hovering at lowest levels since 2000. And these are various companies here: Kirby Corporation, inland and offshore tank barge fleet is paying operator is paying more, and doing so because of competition. Hershey, the candy people, we're seeing standard inflation, but we're also seeing go on wages and benefits. But again, what I think is an industry-wide throughout the country. Patricia Little, the chief economic officer at the candy maker. Republic Services, some of this wage inflation that we talked about is in select markets, but we are handling that well. Robert Half, they are the employment specialists. Margins typically expand in these kinds of markets because we have an opportunity to discuss with clients that say the realities of the market. We are having to pay more. Keith Wendell, he's the chief financial officer there, specializing in accounting, finance, and other relatively high skill categories. They also have some lower skill categories also. You'll then have to pay more to get the kind of candidate you want for an assignment. This is a temporary operation. There are signs that companies are growing less picky. That's good for the army of the unemployed out there. Our clients will be becoming labor consultants because to the extent the first choice costs more, it's hard to source. We help them understand people with adjacent skills, people with little experience. It's based on our data, based on history, can still perform well in those engagements. Oh boy. And we'll see Old Dominion Freight. That's one of the sponsors we hear from various baseball teams. Anyway, we've added folk around the network. That is Greg Gannett, the CEO of the trucking firm Old Dominion. The pressure that we've seen and the issues that we have seen in lost productivity that we have in the second quarter, we've added a lot of folks. We've taken time to get new workers up to speed. The company cut its pay benefit bill at 50.5% of revenue in the second quarter from 52.6 in the same quarter last year. Old Dominion was successful in luring, saying he was glad that we're able to ramp up clean as we need. So that's what some of the firms are doing. And I think we talked a little about contributions here. What's next for GDP after growth since 2014? Well, that's interesting there. We talked about that magic number several times. The economy, of course, grew at the 4.1%. Consumer spending, which accounts for 70% of GDP, rebounded to a 4% growth rate, higher than projected, following a 0.5% advance in the prior quarter, 0.5%. In addition to lower taxes under the biggest overhaul since Reagan, unemployment rates near the lowest since 1969, but it's a different economy than in 1969. Consumer paychecks grew at a slower pace last quarter after tax income adjusted for inflation at 2.6% there, softer than the 4.4% in Q1. Savings rate fell. We already talked about that to 6.8% from 6.7%. Car sales, which held up surprisingly this year, may have trouble maintaining that. Business investment climbed 7.3%. This is sort of a rehearsal of what we already went through. Within the component, spending on structures advanced 13.3%, drilled by oil and gas drilling, driven by, falling a 3.9% gain in the prior, 13.9% gain in the prior quarter. So down a little bit. Net exports, the biggest temporary boost came from small trade deficit. Net exports contributed 1.0%, the most since 2013. The numbers reflect a 9.3% gain in shipments abroad, boosted partially by a surge in a soybean above the retaliatory coming that we talked about. Outlays for government spending, that used to be called pump priming, also helped the pickup, increasing at 2.1% and adding 0.37% to growth. Federal spending rose at 3.5%, the second fastest since 2014, boosted by defense expenditures, while state and local outlays at 1.4% there. So that's kind of an overview of what has happened and what will happen. The housing market, however, is worst slowdown in years. This is also from Bloomberg. There's a 3-bedroom fixer-upper just north of the city. This is out on the west coast, going, for 550,000, down for more than 600,000. This is in Seattle. That's still not enough. The housing market, particularly cutthroat areas like Seattle, Silicon Valley, and Austin, Texas, appeared to be headed for the broadest slowdown in years. That will be relief for the people there. A slew of figures released this week amplify evidence of at least cooling. Existing sales dropped for June for the third straight month. Purchase of new homes were their slowest pace in 8 months. Inventories, which plunged, have begun to grow again. Buyers moving into the sideline. Prices of existing homes climbed 6.4% in May, the smallest year-over-year gain since 2017. So we are seeing some movement there. House prices are plateauing. That is from Ed Stansfield. He's a chief property economist at Capital Economics in London. People are saying, let's just buy over time. He projects, Stanfield, a 5% gain this year and a 3% increase in 2019. So this is compared with 10.7% in 2006. Now, in San Jose, California inventory was up 12% in June from a year earlier. It rose 24% in Seattle, 32% in Portland. These big jumps are from low numbers, and so housing crunch is a serious problem. Some more expensive markets where sales are falling under the weight of prices are seeing a substantial increase in supplies. Well, that's good there. That's called, Dennis Duncan, an agent with Winmai Realty in Portland, said he's trying to manage sellers' expectations, saying that he hasn't had to do since the end of the last housing boom. One customer, baby boomer, moving to a new house across the state, expected buyers to fight over her house. She got one bid below her asking price. So there is some movement down to a more realistic type of situation. The last consumer sentiment survey from the University of Michigan, this preliminary July survey, 65% of Americans say it's a good time to buy a home, lowest since 2008. That is interesting within itself. We wonder about that, but we'll see. We haven't visited those people for quite some time. Anyway, let's finish this up. Shares of DH Homes, Horton, which builds a lot of starter homes, rose as high as 8.7% Thursday morning after the company reported a 12% jump in orders. When property values plunge, market watchers note that the housing sector has strong support from a healthy labor market and steady economic growth, which indicates a stabilizing trend for home prices rather than anything close to a crisis. Wonder about that one. The rate of home sales, new and existing, has probably peaked. That is from Ivan Stephenson, chief economist at Panorama Macroeconomics. It's not going to roll over. It's a general decline. Home ownership in the second quarter was 64.3%, up from 63.7% a year earlier. This is from the Bureau of U.S. Census Bureau. They released some data on Thursday. One of the advantages of doing these roundups, sometimes things that you miss, while there appears to be a slowdown in the growth rate of house sales and prices, it's not slow to rising home ownership. That's from Fannie Mae's chief economist, Sam Kanta, said the statement, though he added that the rate is a full percentage point below the 50-year average, reflecting long-lasting scars from the Depression. New records here, Case-Shiller data. This is from CoreLogic. Case-Shiller data hints at a softening. The 20-year index of property values rose 6.6% in 12 months ending in May. After seasonally adjusted, the gauge posted its smallest monthly gain in 10 markets, including New York, San Francisco, and Washington. Home ownership still remains out of reach for many Americans, especially first-time and younger buyers for existing homes. The median price is at $276,900, while properties typically stay on the market for 26 days, unchanged for the prior 3 months, according to the National Association of Realtors. Affordability is becoming a major headache for home buyers, as from Lawrence Ying. He's the associate chief economist. I thought he was the chief economist there. Anyway, you are seeing home sales rise in Alabama, where things are affordable, but places like California, people aren't buying. So when you start talking about affordability, that's a different case. No one knows how far and how fast borrowing costs may rise at the Federal Reserve. That is from Stansfield said. Lenders and borrowers alike are likely to let credit spiral out of control, less likely as in 2006. With financing tightening, which gains in check, there's not much scope for prices to continue to increase on a sustainable basis. So that's one of the things we have. And let me just get over here. This is the survey of consumer sentiment. The index at in July at 97.3. In June it was 98.2. And in July of last year it was 93.4. Current economic conditions at 114.4. It was 116.5 in June, and July of last year was a little bit less at 113.4. A negative 1.8% change. The index of consumer expectation at 83.3. It was 86.3 in June, and in July of 2007 it was 80. The chief economist, Dr. Curtin there. Let's see what he has to say. Consumer sentiment posted a trivial 0.3 point 1 month decline, remaining half of an index point or less from the average in the prior 12 months since the start of 2017. Despite expectations of higher inflation, higher interest rates during the year ahead, consumers have kept their confidence at a high level for favorable job and income prospects. The mixed positive and negative expectations is similar to past experiences. As in the past, it prevails as long as increases in inflation, interest rates, hikes remain modest. What is unique about the current situation is the potential impact of tariffs on the domestic economy. Concerned about tariffs greatly accelerated in the July survey. Across all households, 35% simultaneously mentioned the tariffs would have a negative impact in July, up from 21% in June and only 15% in May. Consumers whose negative concerns about tariffs voiced a much more pessimistic economic outlook, as inflation expectations were at 0.6% higher than those in that who had not mentioned tariffs, and more likely to anticipate that the unemployment rate rises during the year ahead. Those negative economic expectations could quickly disappear if the trade issues with Europe are promptly settled and immediately follow an agreement with China, Canada, and Mexico. Resolution is critical to forestall decreases in consumer discretionary spending. We'll put this one on because we need to do it. Let's go to the Bloomberg stock market here, and we'll start in Asia. The Nikkei at 1.26. And what else do we have here? Yeah. The Hang Seng at 23. Wait a minute here. Yeah, 23.14. And as we go up to Europe, let's see, what do we have? The FTSE at 33.14. The DAC at, let me see what the DAC was at. They unfortunately put this in green here. And at 51.17. In Spain, 87.90. In France at 31.23. And the Eurostat at 17.92. And to the Dow Jones, they were down 76.01. And the index, S&P 500, was also down 18.62. The Nasdaq was down 114.77. And the Nasdaq Composite Index was down 32.05. And that is the markets. Let's go to the commodities quickly here. The Bloomberg Commodity Index was down negative 0.23. The Reuters Jeffers here was also down negative 0.85. Energy, Brent crude was down 26 cents at $74.29. West Texas Intermediate was down 92 cents at $68.69. T-Bone Pickens has joined his retirement. He remembers the $25 barrel oil. The gasoline index was down 4 cents. The natural gas was up 2 cents. Home heating oil was down $2.17. Gold on the COMDEX was down $2.60 at $1,232.70. On the spot, it was up $1.53 at $1,224.22. Silver, no change, $15.49. We won't bother with copper. We'll go to corn. It was up 50 cents. Wheat was down $6, and cocoa was down $82. Live cattle up $1.10. Cotton, I don't know how we got cotton in this, was up, it looks like 11 cents here. Yeah, it was 11 cents. Well, too bad we didn't have soybeans here. You know where we'll have to go to find soybeans. I'm not perhaps to the BBC, and we can find their commodity index here. Market data. We'll just see if they have it here. I don't know if they have it or not. These are the markets. No. Well, they really kind of got us in a hop here trying to find well, we haven't found soybeans, so we'll have to leave soybeans, as they say, lacking here. Let me just check on our time here. We ran over time as usual. On the 28th of July, 2018, this has been This Week in Economics on the Numbers Man platform of the Bostonred Network. and our sponsor, Cranston Analytics. I thought to remember here that this is a transitional situation we're in. This is the end of July. We're going into August. The Fed, of course, will meet. August being a traditional holiday of vacation time, and it used to be in manufacturing. But plants would close down for a few weeks to retool. We haven't seen any of it, but at the same time, the tariffs are out there. They have taken effect, and how the negotiations will go. No one knows. A car deal with Europe has not been sealed, signed, and delivered, as the song once said. So people are waiting and seeing, and it's kind of interesting. You see Facebook falling almost 20%, but yet at the same time, very little reaction from Wall Street on the other tech stocks. So in other words, as Wall Street has its own quantitative easing type program. What we mean by that is it's that many of the stocks there, i.e. Google and Amazon, etc., are basically talked up by analysts that cover them. So thus, it is out there. But at the same time, there's a caveat, as Dr. Curtin was talking about, when we go to 2019, not 2014 was a benchmark year. But 2019, we see things tending to air out, an old football term, when the quarterback is literally throwing a downfield. So this is an economy that if we go into Q3, which we're in now, and Q4, a different situation there, because the pump priming is out. I'm not certain where federal and state spending that will taper off. And we have elections this year. Of course, 2019 is a precursor to 2020 elections, and that will be a from all of the projections from the models, etc., surveys of the Fed, and you name it. We've seen it will be a much more quote-unquote challenging year for the economy. Could be much more challenging. The housing market, of course, slowing down. You would expect that to happen. It used to be in a traditional American economy, for consumers, housing was the big deal. Because if a person bought a house, they'd have to put in certain big-ticket items, durable goods, washing machines, etc. That has kind of tapered off somewhat. And, of course, we had the tariffs on the machines from China, which raised the cost of those machines in the U.S., washing machines, that is. And Whirlpool benefited in a short-term situation. Now, when you start looking at these various factors out there, will the tariffs on European cars start to affect American cars? Caterpillar is a good example. 50% of their sales are outside of the U.S. So really, if you look at it, China in particular has at least three aces in their hand. They have to just stick to what is. Obviously, as we've said before, they will lose money on the front end. But that will even out in 2019, latter 2019, and their hand will strengthen. So that should be their strategy. Now, the Europeans are a little bit different. Their economies, I should say, are a bit tenuous. Now, Brasic is the other situation coming in. They have to wind that down, at least a plan down. The UK economy is already losing some jobs, and we'll see where the UK is. Japan, who has been in a decade-long deflationary period, finally has crawled out of that. But all of these nations, if you look at it, the EU, Japan, and South Korea, we'll throw them in, is how much artificiality, a new word, of the economy that we see. And are we going to a more realistic economy? Well, we'll wait and see where the so-called tariffs, protectionism, goes, yes, protectionism in the short run is helping the U.S. economy, but only in certain places. The steel plant outside of St. Louis, for example, with 1,000 or more workers there. But at the same time, many of the specialized steel plants that employ 100 to, let's say, 400 people are in danger of workers losing jobs or going into extinction. That is part of the problem there. You create several thousand jobs and you lose 10,000 jobs scattered all over the country, but you don't see the effects of there. For those in business, make next week a productive one. The consumers are beginning to keep their eyes on the prize. We'll see how the old back-to-school thing happens in September. Not as important now with online ordering as it once was, and many of the retail stores are no more.